I'm market analyst Michael Filighera of Traders Helping Traders with the Eye of the Storm podcast, helping you make informed trading decisions for the week ahead. And good day, everybody. I am Michael Filighera from logicalsignals.com and tradershelpingtraders.com. And today I am again joined by my good friend Dan Ascani, and he is representing defendingyourmoney.com, each one of our own websites. And we have been missing several Saturdays, and we know that, and we apologize, but other unforeseen circumstances kind of rearrange people's schedule. But we're back, and we want to continue our behind the curtain type podcasts where we're looking at different things that seem to be happening behind a curtain and not necessarily becoming clear to investors and traders. And so today, Dan has put together a really nice group of things that we want to talk about. And we're basically going to break it up into three particular sections that we want to make sure that we include, because all the data seems to roll around these three different sections. So we're going to be talking about the equity markets and their action from the last couple of weeks and what's kind of guiding that and what is now holding things up and what they're looking forward to in that respect. Second section, we want to talk about our interest rates, and that we want to talk about how the yields are going down and what's happening there. And are we looking for a recession? How does the banking sector problem fit into all of that? And what is the CPi and the PPI figures that we're all waiting for next week? What would they may be contributing to it? And also included in that has been this illustrious, delicious rally going on in gold, where we've seen gold spike back above 2,000. In fact, get above a resistance level that held it for I would say a month, and now it's broken above that level and traded below and back above, as it appears to want to continue to move strongly higher. And the last thing we want to talk about today is some reports that Dan receives and then researches, and those were put out by the Dallas Fed, the Dallas Federal Reserve branch, and they're on the Banking Condition Survey. And that one is telling us a lot about what is going on within that banking sector as far as loans and other illustrious things. So those are our three sections today. And I am not going to get into a whole bunch of talking right here because I want to turn this over to Dan, and he's going to bring us all in, and then we'll have our conversation as well. Thank you again, Dan. I know that we talk every day, but here we are again.
Thanks for having me again, Michael. I love doing these podcasts, so thanks for having me.
You're welcome. Let's go ahead and get started with the equity markets. And Dan and I are in the equity markets every single day, folks, because we are operating our trade room together. And so we're there each and every day. And so, again, we are putting together a picture of what we think is really going on with the equity markets. And quite frankly, and I know a lot of people don't necessarily want to accept this, but what we've noticed, at least over the last couple of weeks, and actually it goes much further back, but strongly over the last couple of weeks, is how the equity markets are being pinned to a particular strike price within the options that are on the SPX, on the ES, which is the future for the S&P 500, also within the NDX and the NQ, which also have options, within the triple Qs, within the spiders, within the diamonds, within the Dow. So all of our major indexes are being controlled by options. And so much so that Dan, and I think it was about 2 weeks ago, maybe a little bit longer, Dan said, Michael, don't you think that what's really happening here is that the options markets are now becoming the underlying, whereas the future is the derivative? And I'm going to let him go into an explanation on that. So with that introduction, I opened it. I know, right?
Thank you, Michael.
I know that was a good one. Well, let's just kind of go in and say what your take on the equity action has been and basically how the markets are relating. And then again, we can tie that into our discussion about the options markets and zero DTE options, which, by the way, folks, are 0 days to expiration. They are in control now, whether we want to accept it or not.
Right. And on that note, it's important to point out that the reason they're in control, or the reasons they're in control, is, first of all, sometime, I believe it was 2021 into 22, options volume began to exceed total volume on the entire New York Stock Exchange.
Right.
So the options, paying attention to what options are doing, and even if you never trade options and never plan to, and the same with futures, you may never trade futures, you may not even like them. But these situations are moving the equity markets around. And one reason for that is zero DTE options plus normal longer dated options. So zero DTE meaning 0 days to expiration. The reason for that is sometime, I believe it was September of last year, 2022, the exchange came out with Tuesday, Thursday options expirations. They already had Monday, Wednesday, Friday. That filled in the gap. Now they expire every day. So institutions or traders or investors, whoever, can buy those options or sell them. But let's say they buy them as a hedge to get by a key report like inflation, consumer price index, or the employment situation report. So that they can buy them to hedge their portfolios, or some people are speculating, and then they expire fast, and they don't have to shell out a lot of money for them like maybe you would for a longer dated option. Right. And I'm not saying there's no activity in longer dated options, but that's the reason why those are so important. The numbers I've seen are that zero DTE options are about 44%, averaging 44% of total option volume. And as I just mentioned, total option volume is exceeding New York Stock Exchange volume. And so your comment on maybe options are the underlying, we've been kind of joking about that, but maybe it's not a joke. The options structure is so important, especially when there's not a lot of volume or activity or catalysts in the stock market. Options volume is so important to watch because that's going to determine pretty much where the market's going to close and maybe even what it does intraday. So this is a very important development. There's a lot of people talking about it, but it's interesting that despite the fact that a lot of people are talking about zero DTE options, it's interesting that I don't want to belittle the media or anything, but the financial media always has to find a reason for the stock. The stock market was up on traders, relaxing a little bit over the banking situation or whatever they assigned to the reason. Right. When actually you and I are paying a lot of attention to the option structure and where the market might pin, so to speak. So we might see a lot of traders, a lot of institutions buying an option or a series of options expiring at the end of the day that have to do with, let's say, the 4100 strike in the S&P 500 cash index, or somewhere equivalent to that in the SPI, the SPIDER ETF, 405, whatever the corresponding number is for the day.
Right.
And so they might buy that. And if a lot of traders buy it, I'm just using buy as an example here because you can also sell it. But let's say you buy the options, market makers are selling them to those traders. So you got traders buying and market makers make a market in the options. So they're selling it to them. So now they're on opposite sides of the market, right? You want the market to go up because you're a trader and you bought, let's say, call options as this hypothetical example. The market maker sold them. You would think the market maker doesn't want the market to go up because they're on the other side. But what they actually do is hedge their trade. They buy the underlying, which in this case, we're talking about S&P 500 options. So they buy the futures to make their directional risk basically zero. So market makers typically will have zero directional exposure. And so they'll buy the futures when they've sold you some call options. And that's just one example. So when there's not a lot of macro flows, as we call it, macroeconomic flows, like investors and institutions who are paying attention to fundamentals or earnings or even technical chart patterns and not options or futures or whatever, like we're talking about, when there's not a lot of macro flows and the exchange volume is light and futures volume is light, the market is controlled pretty much by the option structure, and that's why it's important to pay attention to it. At least that's what we do for our clients. We pay attention to it and make sure that we're aware of what's going on in that particular arena,
Right.
because it's going to move the market. And if there's a lot of activity at a particular strike, 4,100, I'm just using that as an example in the S&P 500 cash, the market tends to go there like a magnet and then maybe even close there.
Right.
So when you see the evening news or whatever, like the market did this on for whatever reason, and we're actually, there wasn't really much of a catalyst for investors. They were actually just squaring out options positions, and it in that 4,100.
I'm just gonna just take us back one short week to the March 31st, to the end of the quarter expiration. And let's go back to the start of that week and the rhetoric that was coming out of the financial media. And again, I don't mean to badmouth the financial media, but sometimes it's like they're very misleading because their job is to try to find out why. So they call around and they call all of these people that they know on the major desks and all the stuff. That, what do you think? What's going on? CPI, PPI, or this or that. When in actuality, it was nothing more than position squaring in advance of a quarterly expiration of hedge fund managers, of portfolio managers, having to decide, well, this didn't work. That is working. Let's switch it out. Let's put that in, because they need to make a report to their customers, to their clients at the end of that quarter. How did my fund perform? Why am I giving you my money? Tell me how you're doing. And that puts a lot of pressure, but it also causes a big flurry of market activity. And it all came at the same time that many people know that JP Morgan, which we also understand is a very, very, very large bank, and it is a commercial bank, it is a big, huge bank, global strength there. And as you mentioned, you did tell us, and those of us in our trade room, you spoke to them as well, saying that for the last 2 years, they've had what in an option speak is considered a collar. And because they have a very large hedge fund at JP Morgan, and this is how they hedge the hedge fund against volatility or movements in the market. And so there was this very large collar that at the end of each quarter, so on December the 31st, on March the 31st, the next one will come on June 30th, but they roll a very large options position. And so the buildup to when they were going to do that and how they were going to do it, because at the price of the SPX at that time was nudging and going and putting pressure on their short call. So everybody then builds a story around that. Oh, what's going to happen? What's going to happen to JP Morgan? And what I found, and then I want your take on this, right, is just how that market activity really built up to that. Because when they finally did get it done, it was, in my opinion, the JP Morgan traders, because it can't just be one guy, it's got to be his desk all with him, came in with such stealth precision and getting that position totally rolled and done without anybody else blinking an eye. Suddenly it was just done. And we're like, oh, here's the options. They're already on. They're over here. Oh, that's already done. And we went on from there. But the whole buildup forced this tremendously strong rally the week of March the 31st, going into the 31st, which is the Friday. And actually, the rally had started the week before and then carried right on through there. But then the market speak is like, well, if that's what they were buying, now that they all have it, we should start to come down. And what happened? The financial media came up with the next excuse why the market. What are they waiting for? Well, they're waiting for the PCE number. They're waiting for this inflation gauge. They're waiting for that. And it's like, they're never going to be. And what they missed was this is all being formed around where the window gets shifted to in terms of where we see calls and puts lining up for our daily expirations. We witnessed that it's really that window for a while was like 4,100 to 4,200. Then it dropped from 4,100 to 4,000. Then it dropped again down to about, I think it got as low as about 3,900 to 3,950, usually about a $50 window. Suddenly it moved back, and then it jumped again, and then it jumped a third time last week. And now it sits at about 4,100. So I just think it's like, how do we tell people how they want to trade? And this is just going to be my side of what we're discussing. And because I get so many people that they're like, "Oh, how do you want to trade that?" It's like, well, you trade it carefully, but if you change your strategy around a little bit, that it's like, I don't think it's going to be real easy to swing trade because the market is schizophrenic. And 1 second they're like dumping, tens of thousands of futures, and then some next 5 or 10 minutes they're buying it all back, and how that can affect your positions. But I think that there are many strategies that can be employed, and you still can play along with them without trading with a directional bias. So without saying I'm bullish or I'm bearish, because I'm not. I can't be, because no matter which side you're picking, you're just going to get killed. But anyway, what would be your take on when we're trying to combine financial media to reality, to zero DTE options, and then what actually physically happens?
Right. So you're right. The media's job is to write about the market and, assign a reason for it. And, they call around trade desks. They have a short list that they have certain people they call for quick comments, and they formulate an article and a reason. And not that the reasons are not valid. It's just that during the day, when traders or investors or professionals like you and me are sitting there living and breathing the market fluctuations, and we see what's happening, like that day you were just mentioning when JP Morgan rolled their collar. There's a lot of things that were happening besides investors, almost like having a meeting and deciding what the reason is the market was going to move. Right. So on that JP Morgan collar, that expires every quarter. Right. It's for their institutional hedge fund, and they use a collar, which is actually a combination of puts and calls that they try to get to as low a cost as possible, or even zero cost if possible, for that hedge, so they can hedge their positions in the hedge fund. Every quarter that expires, and they have to roll it, and it's now commanding a lot of attention from people in the industry, and they know it. So I would have liked to have been a fly on the wall in their trade room, because what we saw from my standpoint anyway, and I'm sure yours too, but speaking for myself, it looked like perfect execution. I mean,
it was perfect. It absolutely was perfect.
You come in March 31st, it's a Friday, it's already end of quarter, and there's already end of quarter flows and some rebalancing going on and some ETFs, etc. There's already a lot of cross currents at the end of a quarter. And then the JP Morgan collar is very large. And so they come in, and one thing they have to guard against is, while they're rolling the collar, against a big market move. And in this case, it looked like they bought zero DTE call options to hedge against a squeeze to the upside.
They did.
Or a rally, even if it wasn't a squeeze. And sure enough, it did rally. And I remember you and I talking about the movement of those zero DTEs that they probably bought. Yeah. And wow, that was masterful, because good thing they put on that edge, because the market did move up, and then it almost got like panicky buying, not by them, but I mean as we got closer to the close, traders came in and they're covering or buying futures, and they're buying out whatever was going on. It was almost like a panicky feeling to the day's trading. And by the end of the day, we could see the volume and the strikes that they put on. They typically sell a call option maybe 5 or 6% out of the money above the market, and they use those funds to help fund the purchase of a put spread, maybe 5 or 6% below the market, expiring another quarter from now. And anyway, it looked like a masterful job. But by the end of the day, there are some media that talk about the JP Morgan caller, but for the most part, most of them don't.
No.
So it's an interesting day, as you mentioned.
It was. And I wanted to toss one more thing in here. And when you and I are doing our analysis, particularly because we both are Elliott Wave analysts, and I know I depend on Elliott Wave, but what you and I both are telling clients, people in our trade room, and things of that nature is that there are changes that we're noticing within Elliott Wave in how we particularly count. And in the structures themselves, we're seeing how the influence of what zero DTE options, or just in the increase in options versus underlying, et cetera, what that is changing. And we're noticing these changes. But what it doesn't seem to really alter very much is our large time frame picture, our big pictures. So again, each week I'm making a big picture update for people, and it's continuing to show, danger, flashing the danger signal ahead. I cannot put my finger on the map and say that's exactly the point it's going to happen, because again, we've got all these other factors at work, but it's not necessarily taking away what's coming. Somehow they've managed to mask what I think is what's happening behind the curtain. And we're going to go on for that. But I wanted to also give you the opportunity to make a comment on that, because it's something we both are noticing. And at the same time, I don't want to use the word reassuring, but I'm going to, because we're reassuring each other. It's like, no, the long-term count is pretty much still solid. It's pretty much still telling us the same thing. The path may change and alter on a midterm to short-term basis, but the long-term, it's the same.
Right. And on that note, and with regard to the Elliott Wave count, as you know, Michael, I published a book 30 years ago called Successful Trader's Companion. Actually, it's kind of bound, not kind of, it is bound as a manual of wave patterns and how to calculate Fibonacci and support resistance, and how to use some technical indicators with Elliott and a bunch of other stuff. And one thing I'm big on, again, as you know, is wave personality. So
right.
R.N. Elliott, who was an accountant, for those who don't know, an accountant in the 30s who came out with Elliott Wave. That's why it's named Elliott Wave. And that's, a way of measuring market psychology, because when the market is moving in the direction of its larger pattern, it's called an impulse wave, and it moves in 5 wave patterns. And when it's moving against that impulse, that overall direction, it's in corrective patterns. And the thing is, there's 13 possible corrective patterns, and those patterns can extend and they can get pretty messy.
They can.
And so that's why I'm big on wave personality, and that's why you and I are talking about what we discuss, pretty much during the week, and that is not just what's the personality of this wave, but how is the market acting? Is it acting like it's in a third wave or a B wave, corrective wave, and so forth? And also, how much is that wave going to stretch? So you're right, the long-term count typically doesn't seem to affect them, but short-term, there's so many different possible squiggles, for lack of a better word, that you see on the charts, and that people who trade, especially short term, have to deal with. And those waves, those little waves that occur, very short term, like during the day or the week or whatever, can stretch or be abbreviated, or you can see patterns that before there were a lot of options controlling the way the market moves when there's not a lot of volume, that stretch patterns is more, for those who know what an irregular correction is.
Yeah.
There's more of those you and I have observed, because that's just the way the nature of the market is right now. So in terms of using the wave count to for your day trading or for your short-term trading, even short-term swing trading, we like to supplement it with other things like we're talking about, the option structure and other things that are going on during the day that might influence the size of a wave, and that's going to affect things greatly. Like you may be right about that it's in a third wave, or the market's going to trace out a C wave, and here's where I'm expecting it to be, and it gets stretched because of all this activity going on, and it goes farther than you think, and that could disrupt your trading if you're not allowing for that contingency.
Thank you. That's true. I think we both kind of put it all together, folks, from what we're both saying, and you're going to come up with a very solid answer to what's kind of happening within equity markets right now. And that, yes, it's affecting the very short-term counts, but not affecting the corrective nature that the market is continuing to move through. So my purpose for having that end of our conversation on this particular section is because we are getting too much flowing in saying, oh no, Fed's going to pivot, Fed's going to do this, and we're in a new bull market. Inflation is done. Inflation's over. We're looking for everything to just go back to being normal. It's like, I think we're so far from returning to what people want to perceive as normal, because we'd have to go back 3 years. That's pre-COVID. And I don't want that normal again, because that produced the problems that we're confronting now. So you're wanting us to go back and to relive and then re-engage in producing in a hyperinflation environment. Enough said. We're going to close out that section. There will be more, because this is an ongoing subject. Obviously, right. The markets are trading constantly. But I want to now go and move over into interest rates. So we kind of broke up today's discussion, folks, into we went to equities, we went to talk interest rates, but we also want to now include a report that Dan receives, and that's also it is public, so you can go out and you can find it as well, and it has to do with the Dallas Fed. So the Dallas region of the Federal Reserve puts out, and I'm not sure of the time, if it's monthly or quarterly or whatever, but they put out a banking condition survey. And it's going to be very, very interesting, because Dan's going to break that down for us. But do you want to start there, or shall we just combine that and then move right into interest rates? Because I think that if we're going to do that, let me just kind of reference a couple of things that we want to try to pull together here under interest rates. And that is that the yields are appearing to go down, because if we watch the markets, the yield, the bond prices are going up, which the yields are declining a little bit here. And so that reintroduces recession conversations. It reintroduces, is that still going to be a possibility? Are we heading into a recession? Some are saying yes, many are saying no, et cetera. How does the banking sector and its health or non-health, deteriorating health, how is that going to be factored into all of this? And then we are also now waiting for our direction to come from, I think you said on Wednesday, we get CPI on Wednesday, along with the Fed minutes. Now, one thing that just before I was sitting down and starting the recording, I said, don't you find it interesting how the Fed minutes are going to be nothing but regurgitating what we already know, what they already did last meeting and reported on and told us all about when the Fed governor came and said, had his meeting, had his press conference. So why would I expect the market to react violently or in one direction or the other based on something we already know? So I find that a very interesting concept, but it's not going to stop it from happening. So I'm going to leave it up to you, my friend, where you would prefer to start. If you want to start with that Dallas Fed report, or do you just want to dive head first into interest rates?
we may go into interest rates, but just a note on that Dallas Fed report, what it does come out monthly, and what it's featuring is something people have been waiting for, and that is for the month of March, which contained the Silicon Valley Bank failure, the Silvergate Bank failure, and then pressures on other banks. How much were banks affected? How much is loan demand affected? And loan volume and credit terms? Because one thing that looks like is happening, and this may not be good news for a lot of people, but hey, we got to be realists here and allow for this to happen. And that is, once you go through what we went through in March with the banking sector, reached a crisis point at a certain point, and the government had to do what they do, and that's paper over these things, but that's a whole nother podcast. But what happens after that typically is if it's severe enough, then we get a credit crunch.
Mm-hmm.
And the credit crunch means banks are pressured by what's happening, and credit terms tighten, and interest rates are already relatively high. So the report that came out from the Dallas Fed was very interesting because loan demand and loan volume plunged badly. I mean, they're back to where they were like the COVID and pre-COVID time period, and also showing some really nasty numbers here. I'm just looking at the Dallas Fed's index number here, loan demand minus 45.6 and loan volume minus 18.3. Those numbers are very bad. That means loan demand is plunging, and so banks tightening credit and also under a lot of pressure for capital requirements, because this particular set of bank failures in March was a little different than what people are used to. We didn't have a collapse or a crash like 2008 or 1987, when just directly after that, there was the SNL, the savings and loan crisis, where 505 savings and loans had to be put to sleep, so to speak. They
starting with Washington Mutual being the largest.
So in 1989, the government formed the Resolution Trust Corporation to just basically absorb those banks and deal with it, and they did successfully. The 2008 crash was messy,
yeah,
and this one was messy. And so what's happening is credit is tightening, terms are tightening, banks are basically lending less, and what happens then if this gets severe, and by these initial numbers from the Dallas Fed, it looks like they are beginning to get severe. What happens then is a liquidity trap is created. What that means is, because of tightening credit conditions, there's less liquidity out there.
Right.
And that's what the Fed gets headaches over. The Fed has to try to deal with that liquidity trap because it's the lender of last resort.
Right.
Although, as an aside, we could have a completely different podcast on the Fed being the lender of first resort in a lot of cases. So they've really, exceeded their mandate in many situations, I think.
Right.
But in terms of the lender of last resort, when liquidity is evaporating out of the system, they supply it. And so the credit crunch typically leads to a liquidity trap, which is what that is, a liquidity, a zapping, not disappearing completely, but a drying up of liquidity.
Right.
That can really freeze up the economy. It's happened a few times before. And so this Dallas report is
just accentuating it. It's really putting a number to it.
Yeah, it's showing that we're headed to the next step of this banking situation.
Right.
That's the credit crunch part.
And as I mentioned, just again, Dan and I talk about what we're going to talk about and how we want to structure it. But when we were discussing the Dallas Fed and that report, I had mentioned that, as many of you know, I live in San Francisco. So San Francisco is a city and a county. So we're all in one. And what I'm now hearing and receiving is that there are it's commercial real estate. So the danger, it's back in 2008, 2009, they were mortgages, but they were home mortgages. They were mortgages for all of us retail people. And how many of those loans were given to people, particularly here in the state of California, where we call them jumbo loans, because most of them are over $1 million. It's like, because of our housing prices being so out of control or just very, very high, you're borrowing 1 million to 2 million or 3 or more to purchase your house. And so the requirements and the lending requirements suddenly just kind of got real soft and evaporated, and people were being approved for loans that they really should not have been. And then what ends up happening is that we get into a serious economic decline or just a retraction. And just like it's happening now, credit starts to shrink. Credit starts to dry up. And what happens is that the marketplace begins to shrink, and now your house isn't worth as much as it was 6 months ago. And now suddenly you're underwater in terms of what your loan is, and now the bank wants the money. So what we're beginning to see on a commercial real estate basis is that prior to the pandemic, there were many commercial real estate projects going up, and those were office towers, folks. And I'm talking big office towers in downtown San Francisco. And companies like Metaverse, except back then they were known as Facebook, went in and leased two 25-story plus buildings, not just a couple of floors. They leased the entire building before it was completed. Before it got completed, we went into a pandemic and everybody got to stay home and work. Now, they're not back to everybody heading down to Menlo Park, which is down in Silicon Valley, which is where Facebook's headquarters are, or even to their existing San Francisco office, which is not within those two new buildings. Now, also on that list, you got Microsoft that leased a bunch of buildings. You got Google that leased a bunch of office space. You've got all of the big tech guys came, oh yeah, we're going to set up, our new tech central is going to be San Francisco. Then we had a pandemic. Now, none of that's really following through. So currently, from what I read, the vacancy rate in the city and county of San Francisco, I think, is at 29%. So 29% of the office space is empty. It's available. Get as much as you want. And people are not renewing leases because it's putting a lot of angst and anxiety onto these commercial owners of these buildings, which happen to be a lot of times they're large real estate investment trusts, et cetera, or just large groups or investment groups, et cetera. And now they are beginning to default on their loans. And part of that is because they can't get them refinanced. So I felt that walks right into what the Dallas Fed is telling us. Credit crunch, it's not available. Would that make sense?
It does. That's one, you're describing one major symptom of the current situation and of a credit crunch. And for those who study the stock market for over time, most I'm going to say most of the serious declines in the stock market have been rooted in the credit markets.
Yeah.
So
yes,
what we're seeing so far doesn't mean in itself the market's going to stage a serious decline or crash, but for various other reasons, the equity market does seem to be set up to be very vulnerable to credit market problems. In fact, it almost seems like it's completely ignoring them because the narrative spread around by everybody right now is, oh, well, the Fed's almost done raising rates and we're going into a recession, and that's good, right? Because that's what the Fed wants, and then they'll stop raising rates and then we can buy more stock. When instead, it could be a very serious problem that even catches the Fed by surprise in terms of its magnitude if this credit crunch really starts to clamp down, and then a serious liquidity trap develops and the stock market becomes like Wile E. Coyote over this cliff, realizing where it is, and bam. So you got to be careful.
That moment when Wile E. Coyote stops and noticing there's nothing underneath him.
And today's Wile E. Coyote might have a Wall Street Journal looking up his put hedges before he falls. Did I put the puts on? I did put those on, right? They haven't expired yet, have they? Because I need to be hedged. That's when everyone heads for the exits at the same time. And floods into put options because suddenly there's a panic. So right now, looking at the option structure and looking at the way the market is structured, the equity market that is, there's not a lot of worry about buying put protection. I'm not saying nobody's buying it, but it's not showing up to the magnitude you would expect if the market were worried about a serious decline. And and it seems to be more focused on the short term, like, oh, yeah, so the Silicon Valley Bank situation was serious, and so was Silvergate and the stresses on the banking system. But, we're past that. The Fed papered over that. It appears to be okay. I can go back to sleep now and just buy more stock. And I'm not trying to be little stock traders. I mean, you and I, the market goes up, we're going to be on it, right? But it seems like the equity market is completely ignoring the potential risks here.
But again, I want to be fair to our conversation in that we see this, that what it appears that the equity market is ignoring, it's because of how it's being spun to the retail, even maybe some institutions that aren't going to be believers or whatever, but it's how it's being spun. And I think it's like if they go do the research on your own, folks, as to the effect of those zero DTE options. And I get a lot of comments on YouTube that are telling me that it's all nonsense. It's like it isn't. And I heard the same thing in 2008 about, oh, no, my mortgage is solid. I make my payments. It's like, you're right. But what's going to happen when your mortgage is more than the value of your home? And you had nothing to do with it. You had no control over that happening. It's the same thing that I think they're setting up for right now.
Yes. And not only that, but part of risk management is contingency planning. So
right.
My advice would be never to sit here and think that a certain scenario can't happen, including one where I'm totally wrong right now and the market's going to go straight up. I've been surprised before by the market. It's a humbling thing. In the several decades I've been doing this, there's been times where I've been humbled, and that could happen again. But and there's been times where I've been surprised because of the amount of liquidity the Fed throws at the market. For example, the COVID crash.
Right.
And directly thereafter, trillions of dollars, unbelievable amounts of dollars thrown not just at the market, but to plug the liquidity trap that occurred then.
Right.
And the stock market went up way more than I thought it would, especially in advance. Like, we're looking at the COVID crash, and we're looking at some calculations on how much the market might retrace of that decline when it rallies, and it just took off to new highs. But unfortunately, that was a symptom of the market bubbling up, as many people who might have bought near the highs found out, because it was really all that liquidity the Fed threw at it that sent it up that way. And so in this case, what we're talking about right now is going forward, the banking crisis, which I hate to throw the word crisis around because it's probably thrown around too much, but it was at a crisis state in March and could end up there again. But when that was occurring, and then the Fed and the government papered over it,
right,
they seemed to, squelch the panic. That doesn't mean that we shouldn't plan for the contingency. The market could collapse and succumb to this potential credit problem.
And it could do it in what, and I'm going to put quotes around it, folks, because I don't really want to like using this term, but it is something that happens just out of the blue. And it's called a Black Swan event. I don't know, there was a very small group of people, and they made a good movie about it, The Big Short, that did actually see between the lines of what was happening in 2008. And they bought puts. But even if you watch the movie, you understand, like Dan was saying, we can be humbled by the market because we could be right, but the market's going to do something stupid before it happens. And it did. The Dow, all by itself in 2008, went to an all-time new high. And none of the other markets, they tried to follow it, but they didn't quite get there. And then what was the end result? It collapsed. In grand fashion, it collapsed. Currency collapsed. Bonds collapsed. The stock market, everything just absolutely took a head dive, a swan dive off of a cliff. Now, could that happen again if commercial real estate is now the black swan event that nobody thought could happen? Oh, that's commercial. Those are well funded. That's all, everybody's got that. They got the building. People are still going to go to work. It's like, that wasn't, we all thought that when the pandemic was over, which it's not, but when the majority of it was over and people can stop staying at home and return to an office, they're not going back to the office. So the ultimate outcome that everybody thinks is going to happen is not happening. So what now? And I want to just shift very quickly, because I am keeping an eye, folks. We are trying to keep it down to a very certain amount of time. And I do want to now just shift and segue right into interest rates, because it's very appropriate. So I'm glad that we kind of reversed our order there. And we talked about the Dallas Fed and that credit and those things, because it segues right into interest rates, which right now the yields are relaxing a little bit. It gets blown out of proportion. But the only way I can really talk about it is on an Elliott wave basis. And in his brilliance of coming up with the Elliott wave theory and the principle, and what guides it is that it doesn't matter what market you're applying it to, the same natural flow is going to happen. And so in interest rates, we got the bond price high in, I believe it was August of 2020. And then we reached our low thus far in October of 2022. And that was, folks, basically a 5-wave structure down. And what happens after you get 5 waves in either direction, you're going to get an ABC, a 3-wave response, right? Decline, 3-wave rally in response. The bond market has done wave A and B, and it's now in the C wave to complete that. So yes, yields are going down because the bond prices are going up, because it's just the natural flow of what the market should be doing now. We could stand by and ask each other, and Dan, you and I have this conversation almost daily. Why would the bond prices go up now and yields relax some when we're confronting everything we're confronting? And we both kind of go, I don't know. And then the next thing you know, it's doing it. So the law of nature, or whatever you want to call it, it's happening. So in that respect, I see it, but it's getting inflamed by all of the talk on the Fed's going to pivot. The Fed has to pivot. They got to rescue the banking sector. All this is happening. Well, that was happening because of this, and now that's relaxed. We've become this short-term focused instead of this term focused. And I think it's a danger. I think it's a big danger. So let's talk a little bit about interest rates. Let's talk a little bit about the recession discussion, and then tail it with the banking sector, if we can. And I got to be honest with you, we got about 15 minutes.
Well, I thought you were going to say 15 seconds. I got worried. So I'm glad this is going to sound strange, but I'm glad you mentioned the word danger, because there's one danger to the narrative of everyone assuming that interest rates are easing off here and bond prices are going up because the market smells a recession coming. Yeah. And that would be an important reason, and it may be a factor, but there's another thing going on here that if you look at the intermarket relationships between, let's say, equities, bonds, fixed income interest rates, and commodities like gold, there's that haven bit in there. What I mean by that is when people get worried, they tend to hide in bonds, government treasuries and so forth. And they also tend to buy gold. Now, there's more to these treasury and gold rallies right now than just that. But what I'm saying is it's dangerous to assume that the whole reason interest rates are easing off recently is because there's going to be a recession. Because if there's something else the market is sniffing out here, like traders or investors, big money is hiding in bonds and buying gold to allocate to that asset class that tends to do well when there's stresses, economic stresses, debasement of the currency.
Right.
Very important for gold, because all this papering over by central banks of all the problems, they just figuratively print more money, paper over the problem. That debases the value of the currency. And that means gold against those currencies, those paper currencies, it gets more expensive and goes up. So if the market is smelling a potential crisis or credit crunch or whatever, and people are thinking that interest rates are coming down and because we're going into a recession and it's going to be a soft landing and the Fed's going to stop raising rates and we can go back to normal, that may not happen. This is something to consider here, especially with what I said a few minutes ago. Risk management begs for contingency planning. I mean, part of risk management is planning for contingencies, and to assume one thing and then be surprised by another could be very dangerous, because if there's another really bad shock to the system and equities, stocks, just collapse,
right,
and all this stuff starts happening, people are going to be caught flat-footed, and there's really no reason for that if you're planning properly and risk and managing the risk in your portfolio. The other thing is, we're talking about the option structure and zero DTE, 0 days to expiration options, and how much that volume is. Those tend to suppress volatility. So what's happening in the market right now is we're getting not false readings out of VIX, but VIX, the volatility index, the CBOE's volatility index, and volatility readings out of the market are suppressed. And so the interpretation normally is, oh, the market's not that worried, so I'm not worried. But the suppression is occurring also for other reasons. Like, it doesn't appear the market's that worried right this particular minute, but there's other reasons that kind of mask the true underlying situation in the marketplace, the financial markets. And that's when volatility is suppressed. So there's a lot of volatility selling going on, and that's helping fund other trading strategies. Mm-hmm. That always happens. But right now, I think it's dangerous to look at VIX and look at the suppressed volatility and assume that the only reason it's that way is because the market's not worried. So therefore I can, sleep well at night and just buy more stock. You got to risk manage that, in my view.
I agree. And I think that was thank you for bringing the volatility. And I know we talked about it and I forgot to write it down, but I'm glad that you remembered to include it because it's important right now. And again, when we're talking about zero DTE options and how they've increased and how the usage of them have increased and by whom that is occurring, and what effects it's having on the market, you are correct in that when we just had the VIX, which was originally set up to measure the volatility in the OEX options, which were a part of, or were originally called, the S&P 100. So they took 100 stocks and they formed an index called the OEX, and then they put options on that index, and then they included options within the SPX family, not the ES, but the SPX, the big daddy. And so they were monitoring the volatility on those options, and that's what moved the VIX. And then therefore, but that's now expanded, right? Because we have VIX on the NASDAQ, we have VIX on the Russell, we have VIX on the Dow, we've got volatility indexes or volatility readings that are much more broad-based. And then again, within the VIX, and all you have to do, folks, if you've got a Thinkorswim like I'm showing him behind me here, or you've got another trading platform that allows you to pull up, just pull up VIX and see how many sub indexes, ETFs now exist that are related to or fall underneath the VIX. All of them trading options, all of them having to deal intertwined with each other about, I buy that and sell this and do this and do that. And so what's really the VIX reading? So as Dan is saying, it's being suppressed, and not necessarily intentionally. It's just the way things are trading right now.
Right. And there's a lot of volatility selling, which can be used for various strategies to fund other trades.
Right.
Because that's what a lot of people do. A lot of institutions do that. You use something in the market to fund another trade.
Right.
And volatility selling is a key way to do that. But what happens is volatility gets suppressed, as we've been talking about. And then all of a sudden, when there's a shock, an overnight headline, or something happens, like, the sudden abrupt failure of Silicon Valley Bank or something similar, when there's an abrupt change or an abrupt shock that occurs, or a black swan event, or not a black swan event, it's just a bad shock, then suddenly everyone's heading for the exits out of those volatility trades, which were selling, and now volatility and VIX are exploding to the upside.
Right.
Those people are then scrambling to cover shorts, and the volatility goes up. That then in turn upsets the market. Not that that's the only reason the market would decline, but all this kind of turns into a feedback loop, just an exacerbated set of reasons why the market's declining very suddenly. That, the COVID crash was a perfect example of that, not to mention any other crash.
Right.
Perfect example of what happens when everyone heads for the exits at the same time. So that's why I keep mentioning risk management, because this market is risky right now. This whole situation is risky. The volatility in the interest rate sector during the time Silicon Valley Bank and Silvergate were failing, and then the Fed was thinking of a solution, and then they did something. The volatility in the interest rate sector especially short-term, well, 2-year yields, for example, 2-year treasury yields were, I couldn't even believe what was happening there. And I've seen volatility in the interest rate market sector before, and I'm sure you have too. So the volatility is intense, and that can really be upsetting. So the market during that Silicon Valley papering over by the Fed, market seemed to be confident just by my perception of what it was doing at the time. It wasn't crashing during that bank failure. It was actually holding up, and then it freed up and then rallied all the way up to above 4,100. So the market was kind of saying, well, we're going to get by this one, these couple of bank failures. But if it becomes more systemic, or there's any kind of contagion that can't be contained, or the market perceives that something's getting out of control, for example, a credit crunch, liquidity trap, bank failure, all at the same time, something like that, then it becomes dangerous to interpret the suppressed VIX or volatility readings as something that means everything's okay.
Right. Wow. And believe it or not, we've reached our conclusion for today. No,
that was 15 more minutes already.
Well, just about. But I figured I'd give us a chance to kind of wrap this up a little bit. It goes really fast because we try to limit our time, but at the same time we're like, but there's so much more to talk about. But the beauty of this is that our plan has always been to continue just to do podcasts and entitle them within my Eye of the Storm podcast, but it's a behind the curtain. So we want to take looks behind the curtain of what we think is actually going on and how that's all being pieced together and being presented, and what's happening with the markets because of what they may or may not see from behind that curtain. So we're going to continue this series of Eye of the Storm podcast, behind the curtain looks. And I know we're going to be bringing back into the conversation, Dan, and I hope I'm not being a little bit too far in advance, but I know that we've spoken a little bit about it in a previous podcast, but you're continuing to work and perfect this very detailed, huge report on a myriad of subjects. And we're going to start bringing that in, I hope, and because it's just something that's so important in moving forward, that we are at a juncture. I think we are at a massive juncture. And I think if people had a more solid understanding of what the signs, let's all pay attention, and now I can see it and maybe be more prepared for it, because it truly is becoming a time when, in actuality, because I have this gold analysis that's telling me I'm looking for 2,500, folks, or even above. How's it going to get there? Well, one thing that I see also happening is a collapse in the dollar. I'm looking for the dollar to drop below 100. Maybe not right now, maybe not in the next month, but I think it might rally a little bit, and then it's going to sink. And when it sinks, gold's going to go through the roof. What's the market going to do? Well, we're going to wait and see how they want to perceive all of that. I'm not sure it's going to be pretty, but you can be prepared. Being shocked is what creates this movement in the market where it's like it turns into a panic. As a day trader, panic is my best friend. It truly is. I don't like to say it that way, but chaos.
You mean not your panic? Not your panic, right?
Not my panic. A panic market produces opportunity that just is wild. It's crazy. And having traded several panics, it's an opportunity to just make your retirement. I don't know how else to put it, but it's there.
Or for those who don't look forward to panics, to protect yourself. And that's one reason I'm finishing up this report. It's years of research and also years of living through this.
Yeah.
And people asking, including me asking for a while there, like, why does the stock market keep crashing? Why are we having recurring crashes and recurring banking problems? And why do these things keep happening? And why does it look like it's going to happen again?
Right.
And so I've put together this report. I'm almost done with it. It's actually the culmination of quite a bit of research. and finding problems and the cause. So this is going to explain in plain English, if I'm doing this right here, why the market keeps crashing, what the cause is, and what's happening here. Because one thing people may not have in the forefront of their mind is when the market crashed in 2008, that was actually a failure of the financial system as we know it. And
Yes.
It's been papered back together by
the Fed,
Treasury and the Fed running the printing presses and papering it back, propping it up artificially through quantitative easing, through zero interest rate policy. And that's been not the only reason the market's gone up, but the reason why we're back in this position again. And after 2008, we had a mini crash in 2015 and a big crash in 2020, the COVID crash. These are happening too often. So the report will be available on defendingyourmoney.com as soon as I'm done with it, which is soon. And we'll be talking more about it, Michael.
We certainly will. And I'm going to wrap it up right there today, folks. And I want to thank you for joining us and listening. And again, this will be on YouTube. So please leave comments for either myself or for Dan. We talk every day. So you leave a comment on my website or and my YouTube page, I make sure it gets to Dan. And so we get those, we got questions, we can answer them. And we will continue the conversations of behind the curtain. And there's much, much more to come on that subject. If you got something in particular that you'd like us to include, please, again, leave it in the comments so that we know, and then we might be able to bring that in into the discussion. But first, I want to say thank you, Dan. It's always, I want to use the word fun because it's really, that's what it is. When we get a chance to talk and connect the dots. And even though that the subject matter is really intense and it is very important, it's very enjoyable for me to work together with you and getting that out there and making sure that people maybe get that second look that will help. So thank you.
Likewise, it's been fun.
It has been. So thank you. And folks, as far as my own updates, tomorrow will be another one, and it's going to be an Elliott Wave update, and it's going to be on the NASDAQ 100 and the S&P 500 as we look forward to next week. And in the meantime, have a great and safe Easter Sunday, and join you on the next update.